Hi everyone, welcome to the Deferred Tax series. This is the basics video and I am Tabby. This is Tutorials with Tabby. Deferred tax is often a misinterpreted subject in the sense that we don't understand the difference between the tax base of an asset, the tax base of a liability, and we don't even understand what deferred tax means and what its objective is. So, as arbitrary and as dumb as this may sound, that's the reason why deferred tax is found to be such a challenging subject. So, we're going to start off at point 3 because point 1 and 2 are very outdated. So you would have likely dealt with the balance sheet method because it's totally understandable and a lot easier. And you calculate your balances and movements using the balance sheet items. So I'm going to illustrate what I mean in a second. But first, let's get down to the definitions. Why do we measure deferred tax? The reason we measure deferred tax is because we're trying to figure out what our expected future tax will be and whether we will be paying more tax in the future or receiving less tax in the future based on each and every transaction that our business has that incurs deferred tax consequences. So it's a forward-looking estimate as to how tax impacts will have on our transactions. So for example, with liabilities, a deferred tax liability would be a future outflow. So you're going to be paying more tax in the future. A deferred tax asset, on the other hand, would be a future inflow. So you'll be paying less tax in the future. Remember, I said it's a forward-looking estimate, so you're not focusing on the now, you are focused on the future effects of tax. The reason we even recognize deferred tax in the first place is because our current year profits from an accounting perspective are after tax. Therefore, any future income or any future expenses that we have to either incur or receive in terms of the taxation elements when we plan for it also have to be after tax. And this discrepancy in our after tax now versus our after tax in the future is what we call deferred tax. So we are deferring our tax payments or tax receipts into the future, and we need to understand what we're going to be paying in the future as a business. Also, there's a discrepancy between what SARS says and what we as accountants say in the formulation of a deferred tax question. So those differences have to be resolved somehow, and therefore we provide for these resolutions by raising either deferred tax assets or deferred tax liabilities in order for us to make sure that our future profits, income, expenses are holistically accounted for. This is basically what we call deferred tax. So we get into point 5 and say we could either have to pay more tax in the future, which is a deferred tax liability, or we could receive tax, better yet, save on taxes, which is a deferred tax asset. Let's use equipment as an example. Equipment is an asset. We need to understand whether the asset's deferred tax liability or the asset results in a future tax saving or a future tax payment. And we do this by looking at the future income, which is the carrying amount, because what is the carrying amount? The carrying amount of an asset are the future economic benefits we expect to derive from that asset. The revised conceptual framework tells you this. If you don't expect to recognize any future economic benefits on that asset, then its carrying amount is 0. And from an accounting perspective, this is what we call the carrying amount. The tax base is the future income that the equipment will generate to the future tax payable or the future tax saving. And the difference between the two, as I said, is called deferred tax. If income is greater than expenses, you effectively have an accounting profit. But if your future income from a carrying amount perspective is greater than your future tax deductions, you have a problem, because you're going to be taxed in the future on that income. And this is why what we call a taxable temporary difference, which results in a deferred tax liability. To summarize it, for an asset, if the carrying amount is greater than the tax base, that means that your future income is greater than your future tax deductions for an asset, and therefore you have a deferred tax liability. Similarly, if your future income, which is your carrying amount, is less than your future tax deductions, you would expect to get a deduction in the future that is greater than the income that your asset is generating, which is a good thing. And that's why it's called a deductible temporary difference, and you'd have a deferred tax asset for the future tax savings. When we go to point 9, the tax base is what SARS views the worth of an asset as. It is the SARS equivalent of the carrying amount. So let's go back to the conceptual framework and think about the definitions. SARS says that this asset will generate these amounts of inflows of future economic benefits. And based on that, they give you a deduction. So it is what helps us calculate this deduction that results in deferred tax. Deferred tax is the temporary difference multiplied by the tax rate. My slides are outdated. It's now 27% for legislative purposes. So always remember that deferred tax is a forward-looking estimate. Point 11 I found really arbitrary, so I removed that page. So now we get to point 12. The tax base of a liability. So the tax base of a liability is going to be defined as any carrying amount from an accounting perspective less any future taxable deductions. The tax base of an asset is defined as any future taxable deductions. So that's how I would remember it. I'd say carrying amount less tax base of an asset for the tax base of a liability. Because if you already know that the tax base of an asset is equal to all the future deductions, and the tax base of a liability is equal to the carrying amount less the future taxable deductions, you already kind of have a link between the two. So now, this only applies for liability that is not income received in advance. So oftentimes in a test or exam, they'll give you income received in advance, and they'll give you an accrued expense such as telephone expense. What I mean by that is income received in advance is an income. So it will be taxed at the earlier of receipt or accrual. Whereas an expense inherently is completely different to an income. So there's a liability that results from an income, which is income received in advance, and there's a liability that is taxed when paid, which is completely different from the income. So one emanates from an expense and the other emanates from an income, and that is why there are two separate definitions for the tax base of a liability, a pure liability, and tax base of a liability that is income received in advance. So basically, the tax base of income received in advance is whatever amount will effectively not be taxed in the future. So that's the layman's definition of it. So for a normal liability, it's Carrying amount less the amount that's going to be a deduction in the future. Whereas with the income received in advance, the tax base is the portion that will not be taxed in the future. So I'm going to go through the next slide and I'm going to give you an example and I'm going to try and show you what I mean. So for a liability that is not income received in advance, you paid your telephone expense for December in January. So you have effectively an accrued expense. So you would debit, I did purchases and creditors for some weird reason, but I would debit my I just hit a blank. Oh my word. I would then take my telephone expense, debit telephone expense, and credit the if I paid my telephone expense, I'm hitting a complete blank and I am not restarting this video. So if it's a liability that's not income received in advance, you have a telephone expense. So you debit your telephone expense because the accrual concept applies and we have to show it in December even though we paid it in January. So our year end is December for the purposes of this example. So you have to debit your telephone expense and then credit your accrued expenses, which is a statement of financial position item. Once you've done that, SARS will then say, okay, this expense is actually going to be deducted. It's going to be deductible now, effectively, in the period in which the expense is incurred, so there's no future taxable deduction. So what happens then? Purchases, or this telephone expense in my changed example, is now going to be 50,000 Rand, which is our carrying amount. The tax base, remember the tax base is the carrying amount, which is the 50,000 Rand. It's deducted when incurred, meaning that this expense is incurred now, so it's deducted now. It's not going to be deducted in the future. So if it's not going to be deducted in the future, that would mean that your expenses accrued would effectively not have a temporary difference, because the tax deduction on the creditors will happen in the current year, so there's no future taxable deduction. 50,000 minus any future taxable deduction, there's no future taxable deduction as it's being deducted now. Carrying amount is 50,000, tax base is 50,000, and as I said, there's no temporary difference and there's no deferred tax. No deferred tax implications arise from this type of liability. Income received in advance, I'll cover in a slide after this. So let's go to point 14. Expenses payable is the one I just did. Even though this is a creditor, like a pure creditor, it works in the exact same way as the liability that are not income received in advance. So a provision I want to speak about. The provision is sometimes completely different, because what happens with a provision is that SARS might allow some deduction. And if SARS allows a deduction, remember, the tax base of a liability that is not income received in advance, a provision is not income received in advance, and therefore your definition is your carrying amount less your future tax deductions. In this case, let's assume there's a provision for 5,000 Rand. So from accounting, you know that liabilities that have an uncertain timing are classified as provisions, and therefore only when paid does SARS recognize that deduction. So let's go back to our definition. Tax base is the carrying amount, which is the 5,000 Rand, less any future tax deductions, which is the 5,000 Rand. So your tax base for a liability that is 100% deductible when paid is zero, because you took the 5,000, subtracted it from the portion that will be deductible in future, and you got zero. Your carrying amount is greater than your tax base. But this is a liability, which means that the carrying amount of our liability is actually greater than the tax expenses that we will have to incur, giving us a deferred tax asset. It is not the same as with a normal asset like equipment, where you get a deferred tax liability if your carrying amount is greater than your tax base. You get a deferred tax asset if your carrying amount is greater than your tax base for a liability. So tax base for non-current assets, the tax base for a non-current asset is typically zero for non-deductible assets, such as land. And for a non-deductible asset, even though the tax base is equal to zero, the temporary difference at initial recognition will be exempt from deferred tax. I'm also going to do one for a non-deductible asset in the following slides. So let's do one where I'm just trying to do one where I don't have to get in depth into the example. So for example, let's talk investment property. If investment property or PPE is at fair value, that means that the carrying amount is now greater than the initial cost, or if it's been revalued down, less than the initial cost. If this asset is measured at its fair value as opposed to the cost model, the fair value will attract CGT purposes. So any amount that's on the revaluation model. So if the carrying amount is greater than the new carrying amount is greater than the original carried amount that you purchased it as, SARS anticipates you to sell this asset at above cost, and deferred tax is at CGT purposes, which is 80% multiplied by 27%, and that would be your deferred tax movement. And yeah, two types of assets are presumed to sell, presumed as an intention to sell, which is a non-depreciable asset like land under the revaluation model, or investment property at fair value. So let me get into an actual example for income received in advance, that is. XYZ Limited receives 50,000 Rand for services on the 31st of December 2022. These services will only be provided on the 2nd of January 2023. XYZ has a year end of 31 December and SARS taxes income at the earlier of receipt or accrual. So carrying amount, 50,000 Rand, it's in brackets. It's purely in brackets because this is a liability. Tax base is zero. Temporary difference is 50,000 Rand. Why is the tax base zero? Because this is the portion that will not be taxed in the future. And SARS taxes income at the earlier of receipt. We've received the income, it's been taxed now, so it will not be taxed in the future. Tax base minus carrying amount gives you your temporary difference. So this is a deductible temporary difference. And your deferred tax is a deferred tax asset of 13,500. How do I know that it's a deferred tax asset? Simply by looking at this. I told you here, if your carrying amount for a liability is greater than your tax base, you have a deferred tax asset, because that means that whatever we're being taxed on is actually less than what we are. Effectively, our liability to SARS versus our liability to SARS is lower than our accounting liability, which is a good thing for us. So that's how we get a deferred tax liability. And because here the carrying amount is greater than the tax base, you're getting taxed less and you get a deferred tax asset. Your journal, debit deferred tax asset, 13,500, credit income tax expense, 13,500 Rand. Doing the same with expenses prepaid. XYZ paid electricity for 100,000 Rand in June 2023. They paid these at year end on 31 December 2022, and SARS allows the full payment as a deduction on taxable income. We have paid, right? SARS defines the tax base of an asset as the future taxable deductions. Yet, we have gotten the deduction now because we've already paid it. That means that the carrying amount would still remain as 100,000, but your tax base, defined as any future deductions for tax purposes, is zero because there's no future deductions. It's been deducted now, meaning that your carrying amount is greater than your tax base. And guess what we have? A taxable temporary difference and therefore a deferred tax liability of 27,000 Rand. Carrying amount is greater than tax base, it's an asset, and we'll not be getting that deduction in future, so this is a deferred tax liability. Journal entry for that, debit income tax expense 27,000 and credit deferred tax liability of 27,000 for expenses prepaid. Now the last one I'm going to do are non-deductible assets and non-deductible assets. With non-deductible assets, IAS 12.15 and IAS 12.24 speaks about non-deductible assets and liabilities. But for your testing purposes, just know IAS 12.15. A temporary difference will be exempt from the recognition of deferred tax if the cost of the asset is non-deductible for tax purposes. So what I mean by this is that if you have an office building is an administrative building which is not deductible for tax purposes, right? And you can have it as exempt if it's never affected accounting or taxable profits. As I said, the purchase of an administrative building. So XYZ purchased an office building for 1,300,000 in 2022. SARS does not grant any deductions on this building. Very similar to what you'd get in an exam. In this entry, you'd have said debit buildings, 1,300,000, credit bank, 1,300,000. This is a statement of financial position item, the bank, and so is buildings. It's a statement of financial position item. So did it touch income? No. Did it touch tax income? No. It never touched our accounting profit. It never touched our tax profit. Therefore, the deferred tax is exempt in terms of IAS 12.15. Your carrying amount is 1,300,000. Your tax base is 0. Even though you'd have a deferred tax liability on this, you cannot, because that would always be a deferred tax liability. So you no longer need to recognize this as a deferred tax liability. It's exempt in terms of IAS 12.15. I hope that these little tidbits of information I've given you have been helpful. It was wonderful recording this video for the 10th time, and thank you all so much. I will be releasing future material on deferred tax. So this is the first part of the deferred tax series. Thank you for listening, and please subscribe to my channel.